What is going on, everyone? Welcome back to the course. I'm so excited to continue to give my community as much value as I possibly can for free. I'm so happy and grateful that you are here learning this incredible journey with me. Here's the cool thing. In the past 6 months alone, I have withdrawn over $130,000 in prop firm payouts. Mind blown. It also motivates me so much because I know I barely even scratched the surface, and this is the great thing about trading. Once it clicks for you, all of those months and all of those years of hardship and pain and agony, once it truly clicks, everything changes. And that is why I am here. I hope to provide you with all the value and wisdom that I can so you guys can not only become the trader that I've become, but hopefully even better. So in the previous lesson, we went over what a fair value gap is, right? It's a 3 candlestick pattern where the wicks of the first candle and the wicks of the third candle do not overlap, and this shows us that we are displacing so heavily in one direction that we create an inefficiency within the market. So typically what happens is the market will like to revisit this area, respect it, and continue in the same direction, right? So fair value gaps are a continuation confluence. Now, inverse fair value gaps is more of a confirmation confluence, and let me tell you why. So here what we have is a standard fair value gap. The first wicks and the third wicks do not overlap, thus creating an imbalance within the market. So like I just mentioned, typically what we will see is the market come back down here, fill this inefficiency, and continue in that same direction. This also applies exactly the same in a bearish scenario where we will create the imbalance. The market will typically come back up, fill the imbalance, and continue in that same bearish direction. So in both of these scenarios, price respects the gap and continues in the same direction. But let's take a look at these examples down here. We still have our fair value gap, right, with these green candles. Okay, we're gonna mark that out. And you could see this following candle displaces down and actually closes below our fair value gap. So what we are seeing right here is this bullish fair value gap being invalidated by this red candle, thus creating an inverse fair value gap. This is going to be considered a bearish inverse fair value gap. Now, if we take a look at this example, it's the same exact thing. We have a bearish fair value gap, which we will mark out right here. And you can see this green candle here, this bullish candle, displaces up and closes above our fair value gap. What do we call this? A bullish inverse fair value gap. Okay, so there's a few things I want to note before we go any further. For one, the inverse candle must close above or below the fair value gap that we are referring to. So like we mentioned here, fair value gap, this box is the fair value gap. We close below the fair value gap, which gives us an official inverse fair value gap. Okay, now if this candle closed right here within the fair value gap, even if it has this long wick down here, this is not an inverse right here. Like I had mentioned in the last lesson, if we have a candle closure still within the gap, we are still technically respecting it, therefore not having an inverse. Okay, now for number 2, the inverse candle does not have to be just the first candle after the fair value gap. It could be the second candle, the 5th candle, the 10th candle. So this right here is a perfect illustration of what I mean. We have the first candle here, which does not close below the fair value gap, so we do not inverse here. The second candle, we wick down here, but we do not close down here. So we do not inverse on this second candle. We inverse on this third candle because we have actual candle closure below this bullish fair value gap. Now, with that being said, if a fair value gap takes 5, 10, 15, 20 candles to get the inverse, if it sort of just trickles and it takes a bunch of time for it to inverse, that's not really considered a strong inverse, right? We don't have that much conviction that we are truly switching order flow in the opposite direction just because we had a lazy inverse, right? What we really like to see is this first or second candle just displace heavily lower with candle closure. Now we can look at this as a very strong inverse to the opposite side and have high conviction that we are going to continue in that direction. Now, before we get into the chart examples, I like to classify inverse fair value gaps in basically 2 categories. The first one is going to be a change in order flow. And I'm going to apply this specific category mainly to the higher time frames, such as the 15-minute, the 1 hour, the 4 hour, anything above that. And it could still apply to the lower time frames as well, but with the 15 or the 1 hour or the 4 hour, when we see an inverse, we have enough time and data and market participation within that time frame that if we are inversing in one direction, that is a true indication that we are switching order flow in that opposite direction. Now for the lower time frames, I like to look at this as more manipulation, and this is all in the sense of us being intraday traders. So on the 1 minute or the 3 minute or the 5 minute, if we are creating finding a fair value gap and inversing it, especially after taking liquidity, I am looking at this as a high probability that we just manipulated participants in the market and we are going to continue in the opposite direction, given the fact that we still have further confirmation and confluence after to confirm that idea is true. Now, like I said before, either one of these concepts certainly can apply to any time frame. We can absolutely have manipulation on the 1 hour, 4 hour daily chart, and we are constantly changing order flow on the 1 minute and the 5 minute. But if I'm going to separate them in different baskets, that is typically how I'm going to approach each time frame. So if we look at the 4 hour time frame, this is pretty much exactly what I mean, right? So we have a bearish fair value gap here. We end up inversing it with this green candle, and what do? We establish bullish order flow and take out this draw on liquidity. Now, once we took that liquidity, what did we do here? We have a bullish fair value gap that swept out this liquidity. And what did we do with this bearish candle right here? We heavily inversed that bullish gap, came back up, retested this new bearish gap that we just created, and then we displaced heavily lower. What did we do? We targeted this draw on liquidity. If we zoom out even further, we take this draw on liquidity. And finally, this draw on liquidity. So as you can see, inverses, like anything in the market, is not always guaranteed that order flow is going to reverse in the opposite direction. But when we pair it with confluences like liquidity sweeps and market structure and fair value gaps, it gives us a lot higher conviction, a lot higher probability that it will reverse and target opposite draws on liquidity. Now, when we scale down to the lower time frames, such as the 1 minute or the 5 minute, this is what I like to see in inversions with my trading model. When we are sweeping out liquidity and then create an inverse, I like to look at that as manipulation. So in this case, we have a bunch of relative equal highs. And what do we call that? We call that low resistance liquidity. And therefore, we have an abundance of resting stop orders that the market makers would like to sweep out before continuing in the opposite direction. So what do we do here? We trade higher, sweeping out all of this low resistance liquidity, and then we displace lower. What do we officially create on the closure of this candle right here? We officially inverse this bullish fair value gap that helped generate a lot of this low resistance liquidity. So as we zoom out here, as we sweep out all of this low resistance liquidity, create an inverse to the downside, and then we immediately displace lower, targeting all of this previous liquidity that we generated earlier in the week. Now, later in the course, once we combine everything and I give you guys the entire strategy in one look and how we could apply it to the markets, then we will be able to combine everything and indicate what is high probability IFVGs, low probability, what's high probability liquidity sweeps, fair value gaps, equilibrium, SMTs, all of these things once we combine everything together. But for now, what I want you guys to do is just go in your charts and identify where do you see these inverses and what do we do after we inverse. Such an examples like this. We inverse this bullish gap to the downside, we displace lower. Inverse this gap to the downside, displace lower. Let me know if you guys have any questions on inverses. I hope this lesson was able to bring you a lot of value, and I will see you guys in the next lesson.